This is Duke University.
Morning to everybody, and welcome to our VC debate. We're going to have hopefully a lively discussion today about kind of the differences in venture capital coming from an incubator perspective and a traditional early stage. So we have Chris Hively from Launchbox Digital and Jason Kaplan from Southern Capital Ventures. And moderating is David Robinson. So David, I'll let you kind of kick it off. Thanks.
Thanks a lot. I'll start with an apology to the organizers. I did not get the memo that said you needed to wear the white Oxford cloth shirt and blue jeans. But,
and socks.
I'm sorry, guys. We'll go just make the best of this. Those of you who've taken my class know that my standard MO is just to try to get a discussion going in the class, and so I want to do the same thing here. I want to leave a lot of room for you guys to ask questions, but I also wanted to kind of give a little bit of structure to the discussion today. And so I thought the easiest way to start would be to just have Chris and Jason kind of maybe you could describe a company that you think is an interesting company, but you would, Chris, you would say, you guys aren't right for us. Go talk to Jason. Or Jason, you'd say, you guys seem like an interesting company, but you're not ready for Southern Capital. Why don't you go talk to the Launchbox guys? Because maybe from there we can kind of get into a discussion of the deficiencies that you see that you try to correct in startups and how, that entire process.
Sure. Well, the first deficiency I would earmark was that usually as a venture capitalist, you'd be wearing khakis, you'd have the white shirt, but you'd have a blue blazer on. So, as evidenced by the fact that he dressed to Launchbox standards,
looking like you,
it's obvious.
Who's the imitator and
who's the originator,
okay.
And who's the imitator?
Yeah. Okay, no more sartorial jokes, guys.
For at least the next minute. But all joking aside, there is a little bit to that dress thing, and I can share with you that when we started Launchbox here in RTP with the model of Y Combinator and Techstars, if you're familiar with these seed accelerator programs, we are filling a gap that is at the kind of, for software only, is kind of at that seed level. And this is where we saw a gap, kind of in that venture supply chain. So we want to get companies that are 1 to 4 people, somewhere between napkin and probably no further along than beta, though we've had some 1.0 products ready when you've come into the program. And, very early stage where we're kind of going to start beating on the model a little bit. We're going to make sure that scales, and we're going to surround you with a bunch of advisors and mentors to kind of put pressure on that model to make sure that you're ready to go to that next step. And I think that next step in the kind of the supply chain
is me.
Is you.
Yeah. So the kind of companies that we typically invest in are the ones that are typically run by a really experienced entrepreneur. So we, like Mike Dornberg, so we funded Mike and Reverb Nation, but looking for that person that's had typically 1 or 2, at least, successful exits in the past, and comes to us with a team of people, developers, that maybe they've worked with before or they know, and kind of a pre-baked team with a model in place. Usually, over the last 10, our firm will be 10 years old this December. So over the last 10 years, we've only funded 2 companies that have been pre-revenue, Reverb Nation and another company in Durham called Artist Labs. Everything else, all of the companies had at least some revenue traction. So they have had, like the last one we did had about $1 million in revenue. And that's important for us because we're able to call customers, call up HP, call up Red Hat in this example, and others, and talk to the customers and get their feedback, as well as introduce them to other prospects, people that we know that may be potential buyers, and get real-time feedback on what the company is what the potential is for the company and for the product. And that's important to us. I would say a lot of our companies have $1 to $3 million in revenue by the time we invest. Some have been lower, as I explained, and some have been much higher. When we invested in Art.com, which was in Raleigh, they were doing $30 million in revenue. We invested in another company in RTP, eTix, was doing over 10. So we've definitely broken out of that $1 to $3 million a few times as well. But the key thing for us is that really experienced entrepreneur.
So Chris, how do you think about due diligence? I mean, Jason's saying that the customer base is actually an important due diligence avenue. Clearly, that's not an option for you guys, or maybe not so clearly.
The due diligence lasts just a few minutes.
For Chris.
By definition. But we're assuming we're going to help do the things that Jason needs to see to get to his level. We're gonna the typical. We have 7 companies in our program right now. We're in week 5 of our 12 weeks over at American Tobacco. I can tell you that every single company at different levels has the same issue, and that is that they have a technology that's kind of interesting. They think they know where that's going to go, but the amount of time they've spent on the technology of the product is this much. The amount of time they've spent on the customer and the market is this much, and we're going to help reverse that flow. So we're getting them to go out and talk to potential customers. We're introducing them we're using our network to kind of blow that open, and so that in the first kind of third of the program, we can get some market feedback as to whether this makes sense. Some of that means we're refining them so that can go out and start generating some revenue, or some of them they're finding their first customers. That's at the end of the 12 weeks, we better have that. That's the key part. Your model's not worth crap if you haven't gone out and tested it and gotten that customer feedback. So we're kind of doing a lot of the job that I think venture capitalists used to do years ago when they had more time. Jason has a lifestyle that just,
That what?
I don't have to say anymore. They know what I'm saying.
I don't have that lifestyle that Chris alludes to, unfortunately.
So it's that's part of that molding that we're helping to do. Anybody see a gap between what Jason talked about and what we're trying to do? Because I think there's a huge gap.
Talk about it.
I want someone else to kind of
No one's nodding their head.
What's the gap?
What's the gap? Come on, it's not that hard.
You talked about an entrepreneur with a proven track record who's already got $1 million, and you're talking about people with really good ideas on napkins. So.
Yeah. So I don't think we've solved the whole problem yet. So Mike, John Glushik was up here an hour before us, and not to get too far about speaking about John, but Intersouth typically does deals that are even kind of farther upstream than Jason. So that's one of the pressure and the friction points to me, and kind of the traditional VC model is that for software companies, Mike talked about this. You don't go raise $3 million, spend 18 months building out your minimum feature set, and then see whether the market likes it. A, you don't have to do that today, but B, no one is doing that deal anymore. So we still have some friction that we need to work through. Now, what I'm hoping is that out of these accelerator programs, that we've surrounded these very small, first-time, typically entrepreneurs with a set of advisors and a mentor and advisory group that might mitigate some of that 2- and 3-time entrepreneur risk that Jason looks for.
Yeah, well, I think what could happen too for some of the companies in Launchbox is as they mature, maybe some of the advisors or one of the advisors or an experienced entrepreneur in the community wants to join them, and then all of a sudden they start getting traction with revenue, they start getting customers, and then it becomes a little bit more appealing for a firm like ours. So Jason, it's about attracting someone, maybe a CEO or an experienced CTO or some kind of component to the company, someone that's been around the block a few times.
Would you look at a company that came out of Launchbox and say, this is a first-time entrepreneur, this is an earlier stage than I would otherwise be interested in investing in, but Launchbox has kind of buttressed this company in some ways that make it attractive, whereas it otherwise wouldn't be? How would you think about it? What kind of a signal does it send to you?
Yeah, what are you going to do in 3 months when I'm done?
Write a bunch of checks. So what kind of signal does this show? Hey, someone's
done.
part of Launchbox as a validator? I mean, I think it's, first of all, they attracted some great people, right? So we have not only they attracted some entrepreneurs here in North Carolina, but they had folks what moved from like New York, West Coast, Colorado. So it's a great program. It's we're a big supporter. It's attracted other entrepreneurs from other parts of the country that normally wouldn't be here.
Yeah.
Okay. For us, I'm an advisor to one of the companies. We keep a close eye on, and everything that's happening. I think it is about, in my opinion, it is a little bit of validator as well. Going back to what would interest us is it's all about, 90% of the decision for us to invest is about the people. Right. Who's involved in the company. I think there's a reason why over the last 10 years, none of our companies have gone out of business. And the reason is the people. I think the great people are able to navigate through that. They have a lot of experience. They've been through multiple downturns in the economy. So we would want to, integrate in someone that we know and trust and maybe have worked with before.
Yeah. So is this a good time for early stage?
I'm with Mike, whoever said it's always a good time. I think it's a great time to be an entrepreneur in the software space here in RTP.
Yeah.
I think with Launchbox and Jason's involvement, and there's a number of other angel funds that are being created. I think someone used the fire reference and kind of scorched and the strong plants survive, and I think we're starting to see a lot of green here. Yeah, a lot of green happening in the last few months.
Because it seems like 2 years ago, VCs were saying, why would I want to invest in early stage companies when I can invest in late stage companies at early stage prices? And that seems like that creates a real vacuum that you guys have kind of stepped in to fill.
That was my thesis all along, that I view this as like a supply chain, and we just have to put a lot more supply, kind of in at the grassroots and the foundation. And if you can kind of use that portfolio approach, we put $20,000 into a company. Anybody know why 20,000? Why do I put 20 and not 200? What's the 20 supposed to represent? Somebody? Do you know what the 20 is supposed to represent?
6%.
It is seed, but the thesis around the 20,000, Techstars is like 18, and there's a group that's 25 in Atlanta. The idea about this much money is it's enough money for 2 to 3 people to live on for 3 to 5 months. So when you think about entrepreneurship is a leap of faith, right? And you think about the 2 or 3 things that might be scary to a first-time entrepreneur. One is, how am I going to feed myself? And so that's where the notion of that 20,000, it's not really to provide you money to go, we're going to provide you everything else that you need at least over that 3-5 month period. So can you live? All right, got that covered. We also provide you all the legal overhead and documentation to set up your company. So you might think, well, I have to spend $5,000 or $10,000 or $15,000 to do that. We've taken care of that for you. So we're checking off the 2 or 3 things that hopefully make that leap a little bit safer. So if you have a great idea, let's mitigate that risk, help you make the leap, and at least get you through the first 5 or 6 months. See, I already added another month because I want you to, live cheap.
Yeah. So you've put them in ramen noodles for 6 months.
Ramen noodle diet.
What do you? What kind of a position do you take in the company?
So we take 6% common equity. So no prefers, no special terms. We want to be a co-founder with you. So we refer to them as co-founder shares. It's enough for hopefully to give us a vehicle from which we could provide a return to our limited partners because it's set up like a venture fund, but not enough that you guys have to think twice about saying this is well worth it.
And you guys get an option to put more money in, right?
Yeah, and then we have a warrant to put more money in at the end of the program, up to $250,000.
I see. And
that is to help that gap
right.
a little bit in case he's sleeping at the wheel. So I want to kind of juice that, So we have maybe 1 or 2 a year that we want to double down on.
Yeah, let's take some questions. Go ahead.
You mentioned this accelerator program. Can you talk a little bit more about it, some of the details, specifically in the context of how it helps bridge that gap to eventual VC funding?
Well, I've done it about 600 times. What do you think it does?
The Launchbox program?
Yeah.
I think I walked through it. I mean, I think it's great for the first time, inexperienced entrepreneur, the first time entrepreneur that doesn't have relationships with a venture capital firm, is it creates another alternative, right? So there aren't a lot of venture firms here. We heard that earlier. There aren't a lot of financing sources. It creates another financing path for the entrepreneur. I know a lot of entrepreneurs that came to us and that I know very, very well here, been doing this for 10 years, who looked at Launchbox and said, I don't want to give up 6%, right? I don't need, $20,000 to get me through a few months, and I don't want to give up 6%, and I don't want to give them the warrant coverage either. So there's a trade-off, right? So, hey, do I want to be part of their program and be surrounded by the mentors? Or do I want to access the mentors on my own? Do I want to go out there without a formal mentorship program and develop my own relationships? So there's a trade-off of giving up equity, and but at the end of the day, I think it's a good program. We're supportive of programs like Techstars and Launchbox. Joystick is another one here in the area as well for the gaming community. And at the end of the day, it creates another financing alternative, so I welcome it.
These accelerator programs kind of have a look, and they all, at 100,000 feet, they all look the same, and they kind of have a goal to kind of help bridge. They refer to them as accelerator programs because in the first 12 to 15 months of building your company, you're going to run headfirst into multiple walls. And you're going to say, that didn't work. It's the wrong market. It's the wrong product. It's the wrong look. So I need to take 2 steps back. Die 1,000 deaths, someone said. So what we're going to try to do, and the reference to the accelerator, is can we accelerate that learning down to 3 months so that you're in a much better position to kind of go to market at the end of that three-ish months. That all sounds good, and it's true. What I tell people, and I think what the companies that are in our program today, and the ones that made it kind of to the short list, almost universally across the board when I asked them, what do you want to get out of Launchbox? It was the advisor mentorship and the setup for potential fundraising through the process. I tell people that at the end of the program, you'll have met between 50, 60, maybe even 70 people, like a Mike Dornberg who's going to come over and spend lunch, a lunch with my companies and my 15 people, that they'll spend time, create a relationship that they may not use that day, but they can use next week or 3 months from now or a year from now. That, to me, is invaluable because to do that on your own takes time and effort.
Mike's got a question.
I do have a question. This is something I've been involved in as I got to Chris. I know Jason really well. And I know I'm not a student here, but I think I want to ask a pretty hard question. Chris, you're taking away some of the risk to a new company. And I would imagine that Jason looks at a company's ability to overcome that risk as one of the filters that he uses to understand whether you should invest or not. It seems almost that bootstrapping your company to the point where somebody would invest in it is almost a rite of passage. It's almost a statement about whether you're worth investing in now. Do you have the sales skills? Do you have the ability to understand and understand the market yourself? Does your management team can it do it on its own, or does it need to be propped up? And I use the term propped up very specifically for this. Is there a certain element of if you make it too easy, you're going to yield a bunch of sort of false positives? Do you think about that, Jason?
Yeah. I think if you look at the history of accelerators throughout the country, I think there have been a lot of false positives as well, right? And there have been some exits. I'm not sure the Launchbox program over the last couple years has had a lot of exits so far. It's early, so but we think about that a lot. I made the comment early on. Hey, does the entrepreneur, the first-time entrepreneur, want the 20K? And is that 20K that important? Do you want to give up 6% of the company? So a lot. We meet a lot. We meet a lot of entrepreneurs here in North Carolina, and we invest in Northern Virginia, DC area, down in Atlanta, and we see people work out of their houses. We see whole companies operate out of a house or out of a townhouse. 10 guys operating out of a living room. They don't need office space, right? They're working out of their own house. So they do, I think, overcome. We like that, right? We want that scrappy behavior. But not to say that I won't look at a company in Launchbox as well, because we do. I was there yesterday, I'm there again today, so we spend a lot of time. We want to be very much in touch with all the entrepreneurs.
Do you think you're taking away some of the pain points? Or do you make painful?
I think this thread is crap. So false positives, you know what? There's hundreds of companies wanting to start. We're just helping the first 3 steps. There's 1,000 steps. So I don't think am even remotely creating anything near a false positive. One of the things I've said about, so traditional incubators would run 2 years. It's university or government sponsored. You get 100 grand. They never come out of their cubicle because they're so into the technology, the product, the research, whatever. This is, I refer to these programs as very Darwinian. It's 3 months and you're pushed out the door. And so I don't think we create even a hint of false positives. I think we provide access. The rest of it, I mean, I can tell you, and if Jason's honest, he'll support me on this, that in every one of our board of directors meetings that we have weekly with the 7 companies, this phrase comes up. It's your company, you decide. We're just here to advise. So I don't think we're kind of taking away any of that, that gritty kind of, hard work that you need to figure out. That's all part of the process.
Yeah.
This is kind of a chicken and the egg question, and this area. This area is growing incredibly. It's consistently ranked in top places to do business. My impression is that there are tons of great ideas born from this area. And continue to do business in this area, but in large part, a lot of these ideas end up being, going to where the money is. You had stated there aren't many VCs, in this area. The question is, on one, why aren't there more here? Especially when you've got some of the big funds talking about this being the next Silicon Valley. If that's the case, well, why aren't they here? How do you attract more of them? How do you get that going?
Yeah, so let me take a stab at that. It's a really good question. We get that a lot, both from entrepreneurs, from our investor base as well. Ask that question. I will say this. So yes, there aren't a lot of funding sources here. Launchbox creates another funding source. Joystick creates another one. But I think the important thing, and we talk a lot about this with our entrepreneurs as well, is that there are a lot of out-of-state venture capital firms that come through here very, very regularly. So I think someone made the comment on the last panel that like out-of-state investors don't really invest here or whatever. I think that's BS. So if you look at all of our companies have raised like $450 million after we invested. I think it's actually higher than that now, maybe over half a billion after we invested. Those are North Carolina companies. So that money is not coming from local sources. It's coming from out-of-state people. And where are they? They're in the Valley. They're in the Northeast. They're coming here, and they're coming back for board meetings. So when they're here, I think the trick for the entrepreneur is to make sure you're on their schedule, right? So, hey, you're flying in for this board meeting, right? Spend an extra hour. I'll meet you by the airport, and you want to present my company. But there's a lot of outside guys. I mean, Trinity Ventures, which is based in the Valley, they're now investors like in 3 or 4 North Carolina companies. They just announced their 4th one, right? So that's rare. It's rare for more of a Valley VC to do that. But for getting a Boston venture capital firm to invest here is easy, and also DC is easy. And why is that? Because competition is really high in that market, and they want to look for other places. You talk to the Boston guys; they're going to Toronto to look for deals, Montreal, right? So coming to North Carolina is a piece of cake for those guys.
I think you and I have as much to do with this process as anyone else. I think if you look in the long run, what's going to do the most to make this area be like Silicon Valley is Duke and UNC and NC State and Central and other, the schools that have, we're long-lived institutions that are kind of dedicated to innovation. And I think that we are as responsible as the investor community in making this area be a success. I mean, we're the supply side; they're the demand side in some sense.
One of the phrases that I heard early in setting up Launchbox was that this area is slightly less than the sum of its parts, and I thought that really nicely illustrated. We've always thought for the last years that we have all the pieces, but they never have added up to something big. Well, there's only one Silicon Valley, and let's get over it. So we are what we are. If I say technology backwater, anybody know what that means this morning? Anybody?
Does anybody care?
Does anybody care? Yeah. Did they mention the last panel? Why? Did they tell you why? This will be funny. So your lunch speaker said that this morning in an interview, that RTP is a technology backwater. And not necessarily wrong, but I also don't think he's right, because I think there's a new wave coming in the past few months. And it's programs like Launchbox, it's events like this, there's meetups just about every week. He talked about networking. There's more and more events where people, entrepreneurs, can get together and share ideas and connect. And I really think it's about the connections. And I think we do have a little dysfunction here, and I think some of that dysfunction has been geographical. But I happen to believe that Durham is starting to become the place for software technology. So Mike, where's Reverb Nation? Where's Launchbox? Where's Jason going to be as soon as his lease runs out?
No. But you know how much
But I'm going to drag him.
You know how much time I spend in my office? Probably,
Yeah.
I'm there probably 5 hours a week in my office.
But point is that I do think some of this is coming together, and it's about connecting people and being able to reach out and find money, find advice, find introductions, find that guy when he's here at the airport. So I do think it's we're on the uptick.
This is a question for Chris. So since you're funding first-time entrepreneurs a lot of the time, what do you look for, and how much of it is the idea versus the person? And what do you look for in the people, mainly?
Yes. So, Jason also will tell you the same thing. So, a C team with an A idea is no good. I'd like an A team with a or B idea. And an A team, I do have different filters. So I'm not looking for multiple entrepreneurs. I'm looking for people who are very passionate about the thing that they're doing. They don't necessarily have to have experience in that market, but they will have thought about it a lot. And so when I start asking questions, they can share with me, a 360 view of that idea and how they've thought about it. I'm looking for people who I think have the ability, and how I find this, I don't know, but that's why we have a team to try to decipher this stuff. But we try to look for people who can pivot if that pivot presents itself. Because as most people will tell you, the idea you start with and the successful idea 5 years down the road is typically not that straight line. So we're trying to find people who, are stubborn to a point of being passionate about their idea, but not too stubborn that they think we can see them take in new information and make different decisions. Now, how do you do that in a 3 or 4 week application cycle is really hard, and I can't tell you we got it right, but we have 7 companies, so here we go. On the idea side, I can tell you we got about 130 applications this year, and out of that 130, I would guess that 50 to 60% of them were Me Too's. And we want to do, we want to be the Yelp of RTP or something. And you kind of go, why would I do that? Do you know what it's like to be successful? And do you know my model is, and as an investment fund, is I want you guys to get big, so I provide a return back to my limited partners. So I'm not just interested in lifestyle business, as I want a return. So 50, 60, maybe sometimes up to 70% are Me Too's. Probably 5 to 10% of them are so big that I don't know how someone gets there at this stage. And then we try to find in that sweet spot, companies ideas that we think are unique enough that we can help do something with. We also, it's a portfolio, so we wouldn't do 10 music. In fact, we got lots of music. We said we're doing none. Launchbox last year did or 2 years ago, we did 1 or 2 music. We said, all right, we've got our portfolio of music. It's tough to be successful. We're not doing any of them. So it's also a portfolio that we're looking at, and we'd like to see, we'd like to help accelerate a number of different kinds of companies. So even if you're the 3rd best healthcare company we saw, we didn't do more than 2.
This question of the jockey and the horse comes up a lot, and one thing that seems clear, though, contrasting you guys, is that, Jason, it's got to be a lot easier for you to shoot the jockey than it is for you, Chris. I mean, given that you're dealing with companies that are later stage, they've already got revenues. If you're looking at a team and you see, perhaps some changes you'd like to make, presumably that's a lot easier.
That's happened once in the last 10 years.
Really?
Yeah. So again, it goes back. Remember the thing I mentioned initially about 90% of the 90% of our decision is investing in people. If I shot that person, that would be 90% of the reason why we invested in that company, right? So we're left with 10%. I mean, we have a really good feeling when we invest in a company. It's like I want the feeling I want to quit my job and go work there. That's the feeling that we have when we back an entrepreneur. It's like we're just so excited about getting in the company, we're high-fiving each other. It's not like, hey, this is a good entrepreneur. It's like, you know what, this is someone really, really special. This is top 0.5% of the market. This is someone we're wild about working with, and not only do I want to work with this person now, but I think about their next company as well, right? So it's like, we call those like kind of a forever relationships, but we want to work, I think about, CEO of Artist Labs. I think about his, I guess that guy's kind of tired right there. Good morning. So I think about Robin Smith's next company. So we backed Artist Labs now. We backed his last company. We think about what he's doing next time around, and so we're kind of thinking forward, and we'll see that as well. By the way, we would absolutely see that. But we want a really good feeling. We want these are guys we're going to work with for the next 9 years. It's a long-term relationship, and we want to back the best people in the market.
Do you ever feel like you haven't taken enough risk because you're erring on the side of?
Yeah, so we think about that a lot. We absolutely think about it a lot. I mean, we think about, hey, geez, should we be running more seed checks? I think, given the size we are, we're a smaller fund, so we're $15 million in size. I think if we were larger, that's something that we'd think about. We did, going back to the first-time entrepreneur thing, we actually really debated this heavily internally, but we were going to do a first-time entrepreneur about a year ago, and we just couldn't get there on terms, but we talked about it. But it was really hotly, really heavily contested in our office.
Portfolio, how many of them percentage-wise go on to receive additional funding from a more traditional, larger scale VC?
Well,
how many have done it, or how many are trying?
How many have done it?
Oh, no, 2
have
years
done
in
it.
DC
Yeah.
to work on. So I need to qualify this because that next round out of a company that's starting at the seed level doesn't have to be a professional VC anymore. And this whole shift that we've talked about in the gaps, there's lots of people moving, and the VCs can't move that far. John Glushik could not do a bunch of $100,000 deals. Their fund isn't structured that way. They don't have enough bodies on the street. So a lot of times that's being filled by really kind of good angels, big angels, angel groups. So if I can take that kind of VC off, or use VC in the broadest definition possible, about 50% of Launchbox companies get a follow-on funding within 3 to 6 months after the session. That's why people come and do that. And that average is similar across Techstars, Capital Factory, DreamIt, the other accelerators. That's a pretty good number. I mean, ultimately, we're going to be judged on exits and returns to our investors, but since they're all within kind of 2 to 4 years of being created, one of the measurements right now is how many are getting funded post-session. So it's been running about 50%. It's been as high as 70%, and it's been as low as about 35% on a year-over-year.
What kind of projects do you see getting that follow-on funding?
Good ones.
So it's pretty diverse then?
You know what? We have a portfolio, and we're looking at what we've seen over the last 3 to 4 months. We're going to see how they moved, what the acceleration. We're going to see what they found out in our market. We're going to see, we basically have a 3 or 4 month due diligence, very intense due diligence period to say these are the right people in the right market.
Yeah.
Plus, we're trying to fill that gap, right?
Yeah.
What type of the difference in involvement that you guys have in the companies that you invest in? Is it do you spend a lot more time, Chris, in working with them on a day-to-day basis versus kind of the traditional route?
So with Chris, not speaking too much for him, but he's right there with them, right, in the same, basically, he has an office and they're all right there in the same room together. But for us, I would probably say it's less than Chris's 90-day thing. But I would say, I'm not sure what, and Chris can speak to this, but I'm not sure what the level of involvement is post, program. For us, it's it goes back to that long-term relationship, and we want to be there for the long term, right? And so, like Channel Advisor, which is a local company, we invested in the company when they're doing $70K a month in revenue, and now they're doing over $3 million a month in revenue. And we help out with recruiting, we help out with sales stuff, we help out with financing issues, legal, anything that comes up, we want to be, right there and help them out with strategy. I went in between Fund 1 and Fund 2, took an interim role there, headed up business development for those guys, helped them close an acquisition, helped up sign up some partnerships as well with those guys as well. So we want to be, especially as a smaller fund, we can do that. It makes it a little bit easier for us, but we want to be a really solid resource for all of our entrepreneurs.
He's the hardest working VC in the area. When you say Mike, he just goes.
Most people don't do that. They don't talk on that level.
I owe you guys checks.
So on the 90-day program, what involvement does Launchbox have with the company? Both in the kind of they get investment from Launchbox follow-on and
well, certainly in a follow-on investment, we're acting more like a traditional VC. We're either going to get a board seat or we're going to get an advisory. We're going to kind of take kind of a role that hopefully is more of what Jason talked about. Now, by we, I'm going to actually blast that we. It may not be a Launchbox person. It may be one of our mentors or advisors. So let me drop back for a second. During the program, every company gets a little board of advisors operating like a board of directors, but without the legal overhang. They're meeting weekly. There's 2 to 3 outsiders and 2 Launchbox people helping advise them on a week-to-week basis. Some of those outside advisors, their incentive is they want to get it more involved. Some of them may turn into a professional relationship and maybe become one of the executives in the company. Some of them may take on kind of an executive chair kind of role where they're very involved. That's a model that we're pushing forward in our follow-on investment. So we want to be more involved in that. That's going to be more of a structured, formal relationship. For the companies that don't, they're still kind of your children. We're still very much involved. A lot of that depends on the company. Some of them are going to move back away. They're going to go back to Berkeley. They're going to go back to Colorado, and certainly that's going to be tougher to do. I'd love them to stay, and I think that a lot of the value for them to think about staying is that environment that we've surrounded them with. But it's going to be their decision. Remember previous comment, it's your company. If they reach out to us and want more help from us, we're there to give it. That's what we love to do. That's why we're doing this in the first place, right? So it's up to the company. We're available to them.
Your question.
Can you talk a little bit about company valuation, particularly for companies that don't have revenue yet?
So
we're much better than Jason. No,
yeah,
I'm just kidding.
So the ones we've done have been. It all depends. First of all, it all depends how much money is going in as well. So the ones we've done was $2 million going in, $2 million pre, so $4 million post, and the other one was $1 million pre, with I think it was we started it with $100K going in. And but that was different because we metered the money in over time based on milestones that the entrepreneur achieved. Both probably ended up around the same, at the end of the day, around the same valuation. But again, we've seen some pre-revenue stuff like be much higher, and it all depends on how much money goes in. So, for us, our model is a smaller amount of money going in, at their earlier stage, and then kind of use that to scale the business and raise money later on at higher valuations. But some, larger VCs have funded, we've seen some companies raise money at a $5 million valuation or a $10 million valuation with a lot more money going in.
I have 2 thoughts. One is, it's no secret that valuations here are not going to be what valuations are in the West Coast. It's just the nature of the beast, and I kind of tell people to get over it. The other interesting dynamic is that for software and technology companies, the amount of cash needed to reach certain maturity levels has never been lower. So I think that gives the entrepreneur a lot more flexibility and in terms of what they raise and that equation that Jason just referenced in terms of what the valuation is. So I try to tell people don't get too caught up in it because what I want you to do is think about kind of the next couple phases and how much you're going to need. It may turn out that $200,000 to $500,000 is all they need for that first professional round of funding to get to that next stage. That number used to be 2 or 3 million. It's now, in the hundreds of thousands. I think that gives you a lot more flexibility on the valuation.
And by the way, my comment was on technology, not life sciences. So I don't know anything about that stuff. I'm not that smart, so.
I can confirm that. The other thing, by the way, in Launchbox is that we have a set valuation coming into the program. So we don't negotiate it.
Yeah.
So it's $20,000 for 6%. That's an applied valuation of $300,000. That's it.
It's low.
I'm curious what you guys see as some of the biggest mistakes that you see both teams and individuals make time and again.
So honestly, I'm thinking about this. That's a great question because I think about our conversation here over the last few minutes, and it's all about financing. But I think we see a lot of companies spend a lot of time thinking about raising money, and not enough time talking to customers or potential customers. And we love entrepreneurs that are better at separating their customers from money than investors from money. So when you think about it, it's like, let me give you a great example. Like Robin Smith, I'll go back to one of our companies here locally. So Robin Smith from Artist Labs, he got funding from one of his customers because what he did is he got one of his, a customer that he had a relationship with prior in his last company, Synthematics. He got the company to write a check for $200K to Artist Labs before the product was done. So who funded the company? Us or his customer? His customer, right? So that provides, that's less money that we have to put into the company, less dilution he has to take. So my biggest advice is to spend as much time as you can with prospects, with customers, understanding their needs and addressing them rather than pitching venture guys like me.
But you said a minute ago that you guys talked about making an investment in a first-time entrepreneur.
Yeah.
And you couldn't get the terms right.
Yeah.
So he was too worried, or you were too worried about the valuation? I mean, can you?
He was, yeah. So
both
of us were. Yeah, no, that's fine. I mean, both of us were worried about valuation, right? So we couldn't get it done because the terms, sucked for both of us. So, we were too low, for him, and plus he wanted more money as well. So, and by the way, this is a really unique situation. You're probably gonna know who it is. Don't say it though. But it was one individual. It wasn't a team. We've always invested in a team. It was one individual. He was working at a large company here locally, and we loved the guy. We loved the guy, and we just couldn't get there. Liked the idea a lot as well. No revenue, but multiple products are up and running that he's built out personally.
And was that his mistake or your mistake?
We'll see.
Yeah.
I won't know until there's an exit or not.
Yeah, right.
We won't know. But I still, we're a big fan of his. I mean, he's or her.
I'm just trying to throw him off a little bit.
Sure. Thank you. But he's a great guy. He did raise money here locally. He built out a team.
And from afar.
Yeah. And he's chasing it. So we're behind him 100%.
Yeah. And by the way, those discussions with Jason helped him look at.
Presumably helped him a lot.
Helped him a lot in where we raised money and.
And
iron sharpens iron. So,
yeah,
and
also he invited us into that deal as well. So we had an opportunity to participate there. He called me for advice on the terms. So I'm very happy for him.
So you guys have an ongoing professional relationship, even though
absolutely.
it's not an investment.
Yes.
Yeah. That's interesting.
Yeah.
We have time for one last.
Yeah. Who wants to take us out? Perfect.
So your goal with Launchbox is obviously to encourage companies to come to the area and hopefully stay. What do you see the value of companies that might go back to a New York or a Berkeley after the program in terms of both for the area and then for Launchbox itself?
Well, for Launchbox itself, if we understand that a number of our companies might end up on the West Coast. At that early stage, if they are successful in raising that first A round, most likely the investor group will ask them to move out there. If that provides them, a path to success, then, and that's the best path, then I'm supportive. If they are able to immerse themselves in a network and be able to get the same advice and, get kind of a watered down version of our advice, 4 hours, 3 hours away, then I guess we're supportive. And of course, we do have this 6% piece or possibly more with our warrant. So that's all good. The advice that I will sit down with all of the companies is, let's make sure that you get as much wherever you're going back to than you're going to get here. And again, it's their decision and I can't force them, but I think there's 1 or 2 of the 7 of the 4 that came from out that are going to stay because they're building up a network here. I think some of their first customers are going to be here. So if that makes sense for them, fantastic. There was another side of that coin, and that was that as I started researching this area and finding out that, including, I know a Duke grad that is out in Y Combinator, people are leaving to get these things. So not only do I wanted to potentially import some people in, I wanted to keep people here and provide them that same on-ramp. So I know that I'm only fulfilling one piece of the gap. I'm hoping that we're going to fill in other gaps or others may actually kind of fill the rest of this kind of supply chain. I know there's still friction points, but I'm doing my piece and hopefully the rest will kind of fall into place. And yeah, I know we'll be in a better place regionally than we were prior to Launchbox. That's how I sleep at night.
Great. Well, let's thank Chris.
Thanks a lot.
Produced by Duke University. Online at duke.edu.